we're going to work on Cookie Company's equity section transactions. And what we have here is just one piece of the accounting equation. This is just the equity section. So you have to use your imagination to imagine assets equal liabilities plus this piece. So we're not going to be looking at both sides of the transactions, only the side of the transaction that impacts equity. Okay, so what do we have here? When Cookie Company Incorporated, they authorized 1 million shares of, look at the name of this preferred stock, $100 par, 4% cumulative non-participating preferred stock. That's a long name for that stock. And it tells us quite a bit about the features of the stock. This little piece here, the $100 par, 4%, is the secret code for solving what the maximum dividend per share is. Cumulative means that if you skip a dividend in any one year, you must make it up before you pay the common shareholders any dividends. You don't ever have to make it up, but if you declare a dividend, it first goes towards the preferred shareholders' current year dividend and then any in arrears. And until that's satisfied, common shareholders would get nothing. Non-participating is about their voting rights. And then in addition to the 1 million shares of preferred that was authorized, 1 million shares of common stock was authorized as well, $3 par common. So that's not a transaction, that just gives them the legal right to issue shares. Those descriptions do go on the face of the formal balance sheet. Okay, now we're going to have some transactions. January 10th, they issued 500 shares of preferred at $110. Okay, so let's issue stock. I have a column here for shares issued and the dollar amount. Now, I can only put par in the preferred stock account. The rest I have to flop over into the paid in capital in excess of par. And you can have a paid in capital in excess of par account that goes just with preferred and one that just goes with common, and that's fine. Or you can have a single one that takes the flop over from either class of stock. So either methodology is okay. I've used one column here just to get it all on the page. Alright, so the par for preferred is 100 and we got 110. So what's going to go in the par account is the par. I can't put anything more. So the $10 that I got in addition to that has to go into the excess of par account. So I did get $55,000, but I have to split it into par and excess of par. Now let's say I also issued some common stock, 3,000 shares at 50. Okay, so 3,000 shares. And what's the par? The par is $3, so I can only put par in the par account. So 3,000 times 3. And the rest has to flop over and be added to the excess for the preferred. Okay, so 3,000 shares. And how much above par was I? I got $50 a share. That's $47 above par because par was $3. Okay, what's the next transaction? In August of year 1, they reacquired 400 of the common shares at 55. Okay, so we repurchased some shares. Those are recorded in the contra equity account called treasury stock. So let's see here, 400 shares times 55. So let me resize that. All right. So what's next? What did they do now? Net income for the year was $50,000. Which of these accounts does net income impact? That's right, makes retained earnings go up. Okay. And then what happened? They declared and paid to common shareholders $5 a share. Well, you can't declare just to common shareholders. The preferred shareholders have preference when it comes to dividends. So if they paid common shareholders, they must have also satisfied the preferred shareholders up to the maximum. Because until you pay them their maximum, you can't pay the common. So let's split the dividends into the two pay groups. And the common shareholders got $5. And how many common shareholders did we have? You don't pay a dividend to yourself. So we would only pay dividends to the shares that were still outstanding. So issued minus treasury is outstanding shares. We have 2,600 shares outstanding. That's 3,000 minus the 400 that are sitting in treasury. So we paid 13,000 to the common shareholders, but we also must have paid the maximum to the preferred. What was the maximum? That was $100 par times the 4%, so $4 a share. And how many shares of preferred did we have? We had 500. So since I had a formula in my sheet already, my totals are being added up for me, and now I'm ready to present these in the formal equity section that would go on a balance sheet. So that would have all the various details, including the formal names of the shares. So let me show you what that would look like. So here's the formal balance sheet. It includes the full name of the preferred stock. It shows the number of shares authorized and the number of shares issued. And then of course here's the dollar amount. Here's the name of the common stock, $3 par. Here's the shares authorized and the shares issued. Here's the paid-in capital in excess of par for both shares. It was combined. Here's the total contributed capital, which is all three of those added up. Here's our retained earnings. Here is our contra account. I've showed it with brackets just to emphasize that it is a minus. That includes 400 shares of common stock, and that may or may not be indicated on the face. I've got it in parentheses. So, and then add up the total contributed capital, retained earnings, subtract the treasury stock to get your total equity.